Dear students, in this class we will discuss the Cambridge cash balance approach, the second version of the quantity theory of money. Now, the mathematics of quantity theory is clear from the equation of exchange MV is equal to PY. Mathematically, M into V is equal to P into Y. This is clear from our basic idea of national income accounting. But what about the economics? The question is how an increase in the supply of money affects the price level. The question is how an increase or a change in the supply of money affect the price level. Now, this question is not answered in the equation of exchange, but we can answer this question more easily if we consider the second version of the quantity theory, namely the Cambridge approach. The Cambridge approach. The Cambridge approach. The Cambridge approach, introduced by Marshall and Pigou, also demonstrates the proportionality between money supply and price level, the proportionality between quantity of money and aggregate price level. But the foundation of this relationship, that is the relationship between money supply and price level, is less mechanistic than Fisher's equation of exchange. Less mechanistic, more economic. Now, the Cambridge economists made a clear distinction in their version of the quantity theory between demand for money and supply of money. The Cambridge theorists, in their version of the quantity theory, made a clear distinction between demand for money and supply of money. Marshall began by focusing on individuals' decision on optimum money to be held. Marshall began his analysis by considering an individual's decision to keep optimum amount of money. Now, some amount of money is always required for transactions to overcome the inconveniences associated with the barter system. So, some money is held for the convenience it provides for conducting transactions. Also, some amount of money is held by the individual for meeting unforeseen contingencies, such as bankruptcy, in the form of an accident, in the form of some other calamity. Every person will keep some money to meet such contingencies. But as Pigou noted, currency held in the hands yields no income. If a person keeps money as currency, it will not yield any income. So, money will be held only in so far as its yield in terms of convenience and security outweigh income lost from not investing money in productive activity. So, the question is how much money will be held by an individual? He will keep only that much amount by equating the convenience with the interest income lost if the money is converted into other form of assets. Keeping excess money means loss of interest income. Keeping less than what is required means there will be inconvenience, there will not be sufficient money for transactions. So only the amount of money held by an individual will be sufficient to meet transactions only. Now, Marshall and other Cambridge economists assumed that demand for money is proportional to income, and the Cambridge equation is written as MD is equal to KPU. Demand for money is a proportion of income, that is MD is equal to K of PY, where MD is the demand for holding nominal money balances, K is the fraction of national income, PY is the national income that is held in the form of money, and this K, as in the Fisher's equation, depends on the payment habits of the society. In the Fisher's equation, V, income velocity, depends on payment habits and payment technology, institutionally determined. In the Cambridge equation, K is institutionally determined. K is institutionally determined. And as it stands, Cambridge equation is a theory of the demand for money. Cambridge equation is actually a theory of the demand for money. And to explain the price level, we must introduce what is known as supply of money. And if we assume that supply of money is determined by monetary authorities, then MS is exogenous. MS is exogenous. Supply of money is determined by monetary authorities, namely the central bank. So, the monetary equilibrium requires that MS is equal to MD or MS is equal to KPY. Equilibrium in the money market requires that money supply MS is equal to demand for money, and K is assumed to be fixed in the short run. And Y fixed, Y also fixed from supply side factors, as we have seen in the equation of exchange. So, given that K and Y are fixed, the Cambridge equation also reduces to a proportional relationship between P and MS, price level and money supply. So, in this version also, quantity of money determines price level. Quantity of money determines price level. And remember this, there is a formal equality between Cambridge K and Fisher's V. MS is equal to KPY, or we can write MS into 1 by K is equal to PY, or that means V is equal to 1 by K. V is equal to 1 by K. That is, V is the reciprocal of K. And if V is constant, then K is also constant. V is institutionally determined, K is also institutionally determined. In this sense, both the formulations are identical. M into V is equal to Py, MS is equal to Kpy, and here V is equal to 1 by K. V is the reciprocal, or K is the reciprocal of V. So, both versions are equivalent in a mechanical sense. But although both versions are equivalent, Cambridge version is one step ahead when you consider modern monetary theories. Also, quantity theory in its Cambridge version is a theory of demand for money. It is a theory of demand for money. Also, in the Cambridge equation, money supply and price level are proportionally related if k and y are constant. And the Cambridge equation provides an explanation to how an increase in the supply of money causes an increase in the price level, which is lacking in the case of the equation of exchange. Suppose that to explain how money supply causes price level, suppose that initially MS is equal to MD or MS is equal to KP, money supply is equal to money demand. And suppose that initially MS was equal to MD. Now suppose that monetary authorities increases the supply of money, MS exceeds KP. Money supply exceeds demand for money. And individuals realize that they have more money holdings than required. So naturally, they try to reduce money holdings by using this excess money for alternative uses like consumption and investment. They try to reduce money holdings by utilizing the excess money supply for consumption or investment. So they demand more commodities, or demand for commodities increase. It puts an upward pressure on prices. If demand increases relative to supply, there will be an upward pressure on prices. But we know that Y is fixed from the supply side. Economy is in a state of full employment. K is fixed due to institutional factors. So, equilibrium can be established only if money supply is equal to money demand. So, the only variable that can change is P. So, P will increase until MS is again equal to MD. So, this is the transition mechanism. How money supply affect price level? How money supply affect price level which is lacking in the equation of exchange. If there is an increase in the money supply, individuals will realize that they have excess supply of money. So they try to get rid of this excess supply by purchasing more goods and services. But supply of goods and services is constant because of the assumption of full employment. So only prices will increase until money market is again in equilibrium. Money market is again in equilibrium. So both these versions suggest that money supply determines price level. So quantity theory of money is a theory explaining price level determination. In the Cambridge equation, it is also a theory of the demand for money. Remember that. It is a theory of the demand for money. In the Fisher's equation of exchange, it is an equation which establishes proportional relationship between money supply and price level. And this is all about quantity theory of money.